Are you just getting started with investing? Then this video could save you thousands. We're breaking down the top 10 mistakes first-time investors make, so you can avoid the traps, skip the stress, and grow your money smarter. Hit that subscribe button, and let's build your future right. Diving into the world of investing can feel both exciting and overwhelming. There's the thrill of building wealth, but also the fear of losing hard-earned money. For many first-time investors, enthusiasm often leads to impulsive decisions. And while making mistakes is part of any learning journey, some investing missteps can cost you far more than just money. They can cost you time, confidence, and long-term opportunity. In this guide, we'll walk through the 10 most common mistakes that first-time investors make and explore how to avoid them. By understanding these early, you can build a solid foundation and increase your chances of financial success. Lack of clear financial goals. One of the biggest mistakes new investors make is diving into the markets without clearly defining what they're investing for. Are you building a retirement fund, saving for a house, or creating a college fund for your kids? Without specific goals, it's hard to determine the right asset allocation or time horizon. For example, someone saving for a home in 3 years shouldn't invest the same way as someone planning for retirement in 30 years. Without a goal, there's no framework to guide your investment decisions. This often leads to random investments based on hype rather than strategy. A goal-focused plan serves as your financial compass, helping you stay on track during both bull and bear markets. Trying to time the market. Another pitfall for beginners is attempting to time the market. It's tempting to think you can buy low and sell high, jumping in at the perfect moment. But the truth is, even professional investors struggle to consistently time the market correctly. First-time investors often wait for the dip or panic sell during downturns, only to miss major rebounds. The market's short-term fluctuations are notoriously unpredictable, and trying to game them usually leads to lost opportunities or emotional decisions. Instead, a better strategy is to invest regularly, regardless of market conditions, through a method like dollar-cost averaging. Over time, this approach evens out the highs and lows and can lead to more consistent growth. Overreacting to market volatility. New investors often get emotionally rattled by short-term market swings. A sudden 5% drop in the stock market can feel catastrophic if you're not used to seeing your portfolio in the red. Panic selling during a market dip locks in losses and disrupts your long-term plan. On the flip side, euphoria during bull markets can lead to overconfidence and risky bets. Emotional investing is often the root cause of underperformance. The stock market naturally fluctuates. Historical data shows that while downturns happen, the market has always recovered and trended upward over the long term. Successful investors learn to stay calm, trust their strategy, and resist knee-jerk reactions. Investing without doing research. Jumping into stocks or cryptocurrencies based on a friend's tip, a social media post, or a trending headline is a common rookie mistake. Many beginners invest in companies they know little about, often driven by FOMO, fear of missing out. This lack of due diligence can lead to poorly informed decisions and unnecessary losses. Responsible investing requires research, understanding what the company does, how it makes money, its financial health, and its future prospects. It's also important to understand the industry, competition, and market trends. Blindly investing without this knowledge is like gambling in the dark. Before putting money into any asset, ensure you know what you're buying and why. Putting all eggs in one basket. Concentrating your entire investment in a single stock, sector, or type of asset might seem like a shortcut to riches, especially if that asset is performing well. However, this lack of diversification significantly increases risk. If that one investment falters, your entire portfolio could be wiped out. Diversification means spreading your money across different asset classes, stocks, bonds, real estate, and even international markets. It cushions your portfolio against volatility in any one area. Even if one investment underperforms, others may perform better, helping to stabilize your returns. A well-diversified portfolio is a cornerstone of risk management. Ignoring fees and expenses. Fees may seem small on the surface, but over time, they can erode your returns significantly. Many beginners overlook the expense ratios on mutual funds or ETFs, or ignore the transaction costs of frequent trading. Paying high commissions or investing in high-fee products without realizing it can quietly drain your profits. Even a 1% annual fee can make a huge difference over decades. It's essential to understand the cost structure of any investment platform or product. Opt for low-cost index funds or brokers with commission-free trades whenever possible. Keeping your costs low means more of your money stays invested and growing over time. Neglecting the power of compound interest. First-time investors often underestimate just how powerful compound interest can be. By delaying investing or withdrawing too early, they miss out on the exponential growth that comes from letting earnings grow on top of earnings. The earlier you start, the more time your money has to multiply. Even small amounts invested consistently over time can grow into substantial wealth. For instance, investing $200 a month starting at age 25 can grow to over $300,000 by age 60 at an average return of 7%. Waiting even 10 years to start can cut that figure in half. Time is one of your most valuable assets, don't waste it. Not understanding risk tolerance. Many beginners invest without a clear understanding of their own risk tolerance. Some may invest too aggressively, only to panic when losses appear. Others may be too conservative, missing out on potential growth. Risk tolerance is influenced by factors like your age, income, financial goals, and personal comfort with uncertainty. A 25-year-old with decades to invest may afford more volatility than someone nearing retirement. Before investing, it's important to assess how much risk you can handle emotionally and financially. This helps you build a portfolio that aligns with your personality and needs, one that you can stick with through market ups and downs. Avoiding these mistakes is half the battle. Now you know what not to do. Ready to invest with confidence? Drop your biggest takeaway in the comments. And remember to like, subscribe, and share this with someone else starting their investing journey. Let's grow wealth the smart way.